Hello, everyone, and welcome to this lecture on the balance sheet. In this lecture, we're going to cover the balance sheet and its components and what it tells you about a company. So again, to cover the three major financial statements of a company, we've gone through the income statement, and now we're going to focus on the balance sheet. The balance sheet does not have any other names. It's typically called the balance sheet. And however, you can identify a balance sheet because the balance sheet will always have these three components: assets, liabilities, and owner's equity. Owner's equity could also be labeled as just equity, stockholders' equity, shareholders' equity, so forth and so on. Okay, so here we are looking at the balance sheet of Intel. And again, you can tell that this is the balance sheet because it has three main items. It has my assets up top, my liabilities here in green, and the stockholders' equity in yellow. Assets are what a company owns. Liabilities are what a company owes, and equity is what is left over. Now, a balance sheet, unlike the income statement, represents a specific moment in time. So we're looking at the balance sheet for December 26, 2020, which is the year ending for Intel. So let's go through the balance sheet, and we're going to first look at current assets. So some of these items that you see here are not on every single company's balance sheet. They may have different items listed, but just to give you an overview of some of the basics that are typically on most balance sheets of a company. Current assets, this is what a company owns, and that can be turned into cash within 1 year. So first listed would be cash and cash equivalents, which is the most liquid assets that a company has, right? This is cash in the bank. This is treasury bills. I mean, I can go to the bank quickly and turn those treasury bills into cash in less than a year. Other current assets, this could be just really anything that doesn't fall under cash and cash equivalents. And you see some things here: short-term investments, trading assets, that could be labeled as other current assets. Accounts receivable, these are amounts that customers owe to the company, right? So typically I sent out an invoice and it's either net 30, net 60, net 20. So I know that that money is going to be coming in within the year. So accounts receivable will always be under current assets. And inventory are, products that I have in my warehouse that are ready to be sold. And hopefully I do not have, inventory that's going to sit there for more than a year. So inventory is considered a current asset as well. So under non-current assets or long-term assets, which is everything that you see under the 47249. So these are items that a company owns, and it includes property, plant, and equipment. And this is the total dollar amount it costs to buy property, plant, or equipment. These are your capital expenditures, the machinery, the vehicles, so forth and so on. Goodwill indicates the acquisition of a company. So something happened with Intel where they purchased another company. We'd have to do more research to find out who they purchased. And it's the difference between what Intel paid for this other company and what the amount of the physical assets of that other company are worth. Intangibles are something of value to the company that you cannot physically touch. Customer lists, proprietary information, a brand name, right? Intel could be, there's money, value to the name Intel. Intellectual property, that would be something like software that was created, and it stays on the balance sheet over the life of the revenue stream that it generates. So they don't have any, Intel doesn't have intellectual property on here, but this is just something you may see on another company's balance sheet. And then accruals and prepaid assets, other long-term assets, that could be the accruals and prepaid assets. So this is if you rent a building and you pay the entire amount up front, you can only record the 1 month's expenses on the income statement, and the remaining amount sits in prepaid assets account. So now we're going to move over to liabilities, current liabilities, and this is what a company owes that must be paid back within 1 year. So here you see short-term debt. So let's say a company took out a loan for $100,000 and 10,000 of it is due this year. So we would see 10,000 here. Accounts payable is the amount that a company owes to its vendors. So I owe my vendors and my suppliers money, but again, I have payment terms with them. It's net 30, net 60, net 90. So I know that I'm going to be paying that within 1 year. And then you have accrued expenses and other liabilities. So this is where you're accruing expenses because you get paid on October 1st for work completed in September. So you have to make the transactions match up to the month of where they're occurring. Deferred revenue, this is money that has been received for services or for products that have not been delivered. And therefore it's considered an obligation to the company, and it is a current liability. And then you have non-current liabilities, and it's usually debt that is due in a year or more. Typically, you'll see deferred taxes, pension liabilities, other long-term liabilities or loans where, deals have been made where these monies don't have to be paid back for, a length of time. And then you have stockholders' equity, and this is what's left over once you subtract your liabilities from your assets. And it includes capital that has been provided by investors. There are retained earnings listed under stockholders' equity or just equity. And retained earnings are earnings that the company has kept within the business for reinvestment instead of paying out dividends. You'll sometimes see preferred stock. People who own preferred stock, they typically get dividends on their investments before the old common stockholder. With the common stockholder, you have voting rights for board members, and the value on the balance sheet is based on the issuing price of the shares. So again, you may see this information or not on different balance sheets that you look at for different companies, right? So our balance sheet equation, assets equals liabilities plus equity, or assets minus liabilities equal equity. So if I look at my total assets of the 153, that equals the 72,053. And the way I'm getting the total liabilities for Intel, because there's not a line item that lists the total liabilities, I'm taking everything from total current liabilities to the bottom, coming up with 72,053. I then add my stockholders' equity, and it equals the 153. I could also take the 153,091 minus my liabilities, and it will equal 81,038, right? Because the balance sheet must always balance. So this is a quick snapshot of how you can formulate a balance sheet into your own personal life, right? So in your personal life, you have cash in the bank. You have a house, you own a car, you own stocks, you have a retirement account, You have a massive amount of jewelry and you have a college savings account. These are assets. These are things that you own versus the business. They're labeled differently, right? They have accounts receivable, intellectual property, so forth and so on. And then you also have liabilities, right? Just like a business does. You have credit card debt, perhaps. Maybe you have a car loan, a mortgage, and a student loan. So you have assets and you'll have liabilities. So we're going to put this all together for you to come up with your personal balance sheet. And here you have cash, a car, and a home. So your assets are worth $131,500. Your liabilities total $204. So your net worth, right? So if you're looking to have a personal balance sheet, the end is your net worth. You're minus $72,860. So something has to be done here to be able to get that net worth into the positive, or else you're either going to default on your loans, or something else. And so maybe you can increase your cash, or maybe you can sell your car, or do something with your credit card debt to make this number positive. So here's what we've learned in this lecture. The balance sheet captures a moment in time. The balance sheet must always balance. Assets minus liabilities equals owner's equity, or liabilities plus owner's equity equals assets. Assets are what a company owns. Liability is what a company owes, and owner's equity is what is left over in a company, and the company can decide what they want to do with what is left over: reinvest, pay out dividends, so forth and so on.